Welcome back to the channel. In this video, I'll provide my usual monthly update of my InvestEngine stocks and shares portfolio, a portfolio for which I have a goal to reach £100,000 over the next 3 years. But before we do that, I want to quickly recap the reasons why I've chosen my portfolio specific ETFs and what my plan is for them this year. So let's start off with the reasons why I've chosen my portfolio specific ETFs. My portfolio strategy is based on two principles. Firstly, global diversification, and secondly, low-cost ETFs. At this point, you may be thinking, why are you focusing on diversification? Why not just focus and bet on the big American companies, as America has outpaced the worldwide stock market in recent history, and specifically large American technology stocks have seen huge growth compared to the rest of the stock market. If we compare the returns of the S&P 500, which is a good gauge of the US stock market, versus the global stock market over the past 10 years, we can clearly see the dominance of the US stock market. However, over the longer term, over the last 50 years, this dominance is less clear-cut. This graph shows that US and international market performance tends to move in cycles. And although we are seeing a long current cycle of US dominance, history suggests this cycle is unlikely to last forever. If we walk through the performance of the US versus the rest of the world since 1969, we can see that there's been plenty of cycles where international stocks have outperformed the US market. For example, in the 1970s and early 1980s, the rest of the world, led by Japan, had the better performance. In the 1990s, the US made the larger gains. However, in the 2000s, the emerging markets spurred the rest of the world to have the better performance. Then for the last 10 or so years, the US have of course dominated thanks to the huge growth in tech stocks. So history shows that countries and sectors change in levels of influence over time. And I simply don't know what sector or country is going to dominate over the next 10 or 15 years. So instead, I've chosen to hedge my bets and bet on all companies in the market for a globally diversified portfolio with a goal to follow the overall market trend upwards. And to achieve this globally diversified portfolio, I use three main ETFs. Firstly, the HSBC MSCI World, which covers the developed world and is made up of mid and large sized companies. I've allocated 60% of my portfolio to this fund. The second fund is the iShares Emerging Markets ETF, which covers emerging markets such as China and India. I've allocated 10% of my portfolio to this fund. The next fund is the iShares Small Cap Fund, which also makes up 10% of my portfolio, and this fund covers smaller companies from the developed world. And this fund enables me to be diversified across company size, as the previous two ETFs only covered mid and large sized companies. So overall, with these three ETFs, I have exposure to nearly all of the stock market across three lenses. Firstly, across countries, secondly, across sectors, and thirdly, across company sizes. However, those of you who clock the maths will have realised that these three ETFs only cover 80% of my portfolio. The next 10% of my portfolio is invested in precious metals, in gold and silver funds to provide diversification outside of the stock market, and the final 10% is dedicated to funds in my passion sectors, which are cloud computing and battery solutions. So that was a bit of a waffle as to why I've chosen my portfolio specific ETFs. My plan for this year is to broadly keep the same funds in similar percentages. The one change I may make is to focus on the cloud computing fund over the battery solutions fund for the final 10%, my passion 10%. So that's my portfolio. And now we know the portfolio, we can take a look at the performance of it over recent months. But if you're new to the channel, just to recap, I'm Alex, a management consultant by day, and on this channel we like to talk about all things personal finance with particular focus on how to grow your money. If you're enjoying the content, I'd greatly appreciate a like, as it's super helpful for smaller channels like mine. And if you'd like to follow my own personal finance journey with regular video updates like this one of my InvestEngine portfolio, as well as video updates of my Monzo portfolio and a bunch of other personal finance videos, then I'd greatly appreciate a subscribe. But for this video, let's continue with the performance update of my InvestEngine portfolio. And before we do that, we need a reference point to see how the overall markets have been performing, as this will likely explain my own portfolio's performance. And for any of the regular viewers out there, you'll know the reference points I like to use in the FTSE 100 and the S&P 500. we can see the S&P 500 was down over the last month at the time of recording by a marginal amount of 0.23%. If we bring it closer to home for the folk like me in the UK, we can see the FTSE 100 had much worse performance. This was down by 2.58% at the time of recording. So the market has been fairly stagnant in the US, but it's been in significant decline in the UK. And this bad overall market performance is not too surprising for January, given we've received higher than expected inflation data, which has created doubts regarding when interest rate cuts will happen. As we spoke about in previous videos, much of the recent market movements have been driven by if and when the market believes interest rate cuts will happen and be enforced by central banks. This month we've seen inflation data which is higher than expected. In the UK, it's 4% at the time of recording compared to 3.9% in the previous month. And in the US, the most recent data is a 3.4% inflation figure compared to 3.1% in the previous month. So the inflation rates have gone up in the US and the UK over the last month. However, it's my opinion that we're still on the right path, and this is just a temporary increase on a long-term trend downwards. If we take a longer-term view of the inflation rate, we can see we're in a much better position than 18 months ago, where US inflation and UK inflation was at over 9%. And although there's still work to do, it seems that most people agree that we're nearing the end of the high inflation period. Even a Fed official recently stated that we're now within striking distance of the Fed's inflation target level of 2%, which is a crucial metric for them to start thinking about rate cuts. And the market is still very much expecting rate cuts this year, midway through this year, if not earlier. As although inflation hasn't been ideal this month, other metrics have been more favourable to the rate cut agenda. For example, wage growth was 3.8% in the US in December, and this follows a steady 2-year decline from a peak of 9.5% in late 2021. And this is extremely important, as falling wage growth is a trend which central banks want to see before they can conclude that inflation can sustainably stay at a low level and interest rates can be cut. So overall, it's been a rather stagnant month in the US and it's been a bad month in the UK. But there's still a positive feeling that interest rate cuts will happen sooner rather than later, which will be a huge positive for the market. So now we know the market performance, we can take a look at my own InvestEngine portfolio performance using their app, of course. And we can see that over the last month, my portfolio is in the red. It's down by 0.28%. And this isn't too surprising given what we just went through with the markets, and given that most of my portfolio is exposed to the US market, it's not surprising that my performance is closer to the US market performance than the UK market performance. And if we look at this graph here, we can see how the performance evolved over the last month. And if we don't consider my contributions, my deposits, we can see the portfolio has been rather stagnant. There's been some slight increases, some slight decreases, but on the whole, it's been stagnant, leading to this marginal negative performance. The reason why my contributions are slightly higher, my deposits are higher this month, is because I've recently had a fixed term savings account mature and want to put this money, well, have put this money in this investment account. I also want to max out my ISA allowance for this financial year, so we'll be increasing my deposits compared to usual in the next 3 months. So overall, we can see I've had marginal negative performance across the last month, but on a long-term investing journey, I do expect that some months I will see negative performance on an otherwise long-term positive trend. And even if we zoom out over the last 6 months, we can see positive performance, particularly in November and December. So I'm not worried that I've seen negative performance this month, as I'm still expecting the long-term trend to be positive as history suggests. And let's now take a look at how the ETFs in my portfolio performed over the last month. And let's start off as always with the HSBC MSCI World, given this makes up the largest proportion of my portfolio. This ETF was up by 0.97%. And the beauty about this ETF is that it's exposed to many different developed markets. So even though we saw many regions over the past month do poorly, this ETF has also been exposed to regions which have done well, and this has meant that this ETF is still in the green. The next ETF is the iShares MSCI World Small Cap, and this is down by 1.05% in percentage terms. And it's not surprising that this ETF is down, as it's heavily influenced by the sentiment around interest rates, and although the market is still expecting interest rate cuts, it's not quite as confident that they will happen very soon. So it's not surprising that this ETF is down by just over 1%. And for similar reasons, the next ETF is also down, the iShares MSCI Emerging Markets Fund. This fund is down by 1.69%. The next fund in WisdomTree's cloud computing is marginally down, it's down by 0.61%. And the following fund in iShares Physical Gold is also marginally down, it's down by 0.04%. The other precious metal ETF in my portfolio was also down over the past month in the iShares Physical Silver. This was down by 4.23%, so not very good performance for the silver ETF. And the worst performing ETF in my portfolio is the last one here, the WisdomTree Battery Solutions ETF. This was down by 5.88%, so terrible performance for this ETF. So overall, on the individual ETF front, the HSBC MSCI World Fund was in the green, but the rest of the funds were in the red over the past month, and this contributed to my overall portfolio being marginally in the red over the past month. And as we spoke about a few minutes ago, I'm not too worried about being in the red this month, as I'm a long-term investor, so expect to be in the red some months on a long-term journey towards positive portfolio returns. And that finishes off this video. If you want to check out my overall plan for this portfolio to reach 100k over the next 3 years, then you'll be able to find a video around here. But for this video, thanks for watching.